I'm Greg Hunter. Welcome to USAWatchdog.com. A return visit by a guy. I used to read his site when I was at CNN. I loved it. It's dollarcollapse.com. And the guy who started it up back in 2005 is John Rubino. John, let me get on my thing here. John Rubino, thanks for joining us today on USAWatchdog.com.
Hey, Greg. Yeah, it has been a while, hasn't it, since we've been working together?
I started reading your site, and you didn't know me then, and I started reading your site back in 2005. It was wow, you started it as a site for a book that you and, who was doing it? You and James Turk were doing, correct?
James Turk, yeah. It was called The Coming Collapse of the Dollar.
Yeah. And well, go ahead.
Well, it was just a marketing page for a book at first. And then gradually it's evolved into more than that. Now it's a blog and a news aggregation site that I didn't expect to actually be a job this far into it. And the other thing is that when we were writing that book back in 2004, our biggest fear was we wouldn't be able to get that book published in time for the global financial system to blow up. We thought it was so imminent that the numbers were so huge, and this system couldn't survive beyond 2005. And it turns out here we still are. The system has somehow managed to stagger along and take on even more debt. So I think that's become the most interesting story of all now. How did we manage to do this for such a long time? How did we keep it going?
And money printing and fraud?
Yeah. And if that has worked for 10 years, where does it have to end? In other words, can we keep going like this, or does it have to blow up on us at some point in the not too distant future? And, I, of course, think soon, because the numbers just seem unmanageable. But because I was so wrong about the system having to end back in the mid 2000s, who knows now? It seems like the end is near, but you just never know what kind of tricks these guys have up their sleeves.
Well, even Paul Craig Roberts said that, we would step on the gas for 6 months and then we'd let off. He was Assistant Treasury Secretary. And I think back in the Reagan administration, and he says, now, how long have we been doing this? Since 2008, and here we are, 2018 or 2009, I guess. I don't know. Whenever the crash got into full bloom, we had QE1. So nobody expected the fraud. It just had more manipulation in the gold and silver market by one of the big banks, one of the big money center banks again. Which they've been telling us for years they didn't do. But I read this article which plays into it. They did it by extending the debt. That you could basically say, right? How did they do it? The global debt was 70 trillion dollars in '08, and now it's $250 trillion.
And that's just the official debt, which segues into the New York City story. Unfunded liabilities are actually bigger than the official debt, but it's real. An unfunded liability for a pension fund is a real obligation.
Let me get your article title. It was the New York City joins the imminent bankruptcy club. And when I read this, I thought, this is one city. Talk about let's start with there, which is a smaller morsel people can bite into, but it's a huge chunk of steak. Start with the imminent bankruptcy club of New York City, one city, and how bad off they are.
Well, New York City just announced some really astounding numbers that I wasn't aware of, and I've been covering the pension fund unfunded liabilities story for a long time. But they just announced that they have unfunded liabilities for retiree health care, just retiree health care, not the rest of their pensions, of $100 billion. And that's for a city. As you said, it's for a city, not a state or a country. And if you add their unfunded liabilities for their pensions, which is another 50 or so billion, and their official debt, which is 50 or so billion, you get $200 billion that New York City's on the hook for that they have not put money away for. And, if a private sector company had finances like that, they would be held to be insolvent, and their accountants would force them to say that. But governments can get away with this stuff in ways that the private sector can't. And so they're able, as you said, to kick the can down the road, to keep things going by keeping accounting issues from being cash flow issues. But that doesn't work forever. And all these baby boomer New York cops and teachers and firefighters are retiring now. And they're going to be drawing on those promises. And where does New York get the money? It's not clear that they can come up with that kind of money on top of all their other obligations. Running a city is expensive. You got roads to take care of and bridges to make sure that they're not going to fall down, and all kinds of other things that are ongoing expenses that eat up your annual tax revenues. So if you have to add on massive public sector pension obligations,
and medical benefits,
it breaks the bank for a lot of these guys.
And medical benefits.
Medical benefits. Well, the unlimited health care for life for somebody who retires at 60 is a really big expense, and they're not accounting for it. What also was also in their announcement, or in the article that covered their announcement, was that if you work for the New York City government for 10 years, one of the perks of that is unlimited health care for life. You get covered forever in 10 years of working at New York City. I lived in New York City in the 1980s, and if I could go back and do it again, I think I would have tried to get a government job for a decade and then have health care forever. But at least until they can't pay for it anymore.
Well, and I hearken back, and I've been bringing this up as people think, you owe 50 billion or 100 billion or wherever you owe, and I hearken back, and I've been bringing this stat up over and over again, and it's the Puerto Rico bond situation, which they defaulted on their debt, and they could either pay bondholders, or they could keep the lights on and keep the water flowing and the trash picked up, and they decided not to pay the bondholders, and so a default on this. A debt or a default on the retirees, that's the most likely scenario, because if they could either pay the retirees or they can let the trash stack up in New York City. What do you suppose the mayor and the council members are going to do?
They're going to be in a pretty tight box pretty soon, because you need to do all of those things ideally, and if you have to choose one, stiffing your bondholders is probably the one that you would choose if you're up for re-election pretty soon. But that closes you out of the debt markets going forward at a minimum.
Oh, yeah. Puerto Rico.
Yeah. So from that point forward, you have to live within your means. And if you're not currently living within your means, that means you have to make the cuts necessary to get yourself to that place or raise taxes. Either way, you end up in basically Illinois and Chicago's situation, where taxes keep going up, services keep diminishing, and people keep leaving. So the tax base shrinks faster than you can raise taxes to make up the difference, and you enter a death spiral. And up until this point, most people have been saying that Chicago was the first domino to fall, right? Because their finances were so terrible, and some kind of a crisis was so imminent that they would be the one that would be the headline story for the public pension crisis. And then everybody else would follow after, when people start looking around and asking who's next, and finding that, there's 100 other states and cities in basically the same boat. And so we're going to sell their muni bonds too and cut them out of the bond market. And then everything starts to fall apart. But it could be that New York is right up there with Chicago with numbers like this.
I think they exceed Chicago, frankly, because you got numbers of their numbers are equaling the entire state of Illinois, from what I can.
Yeah. Well, New York is bigger than Chicago, and in some ways richer, because New York has Wall Street, but it's also more cyclical, because New York reaps massive tax revenues when there's an equity bull market going on, because Wall Street is generating huge year-end bonuses and all those guys are paying taxes and et cetera, et cetera. And when there's a bear market, that evaporates. See, that's California's problem too, because they make so much money from tech IPO capital gains. And when that goes away during a bear market, then their tax revenues plunge too. So the next recession is when all this stuff is going to come to a head, because the numbers will stop working in a cash flow sense rather than just an accounting sense.
And if you look at all these, if you ball this all together with the entire global debt picture, this is just a little chunk of the global debt picture, right? I mean,
well, this is one more thing
I mean, it's just not it's China, Italy. I mean, the Italian banks are having trouble. They want to have their own budget. They want to print their own euros, and euros doesn't want to do that. They may end up going back to the lira. I
Yeah,
mean,
see, I can talk about Italy because these are my people. I'm of Italian extraction, and that's been an ungovernable country for ever since World War II, or if not since before World War II. And what they used to do before they joined the Eurozone is they would run up huge debts by living in the present and not bothering to pay taxes in the moment, and then they would have a currency crisis and they'd have to devalue the lira, and that would reset the game, and they could go back to borrowing too much and living beyond their means, and they could do that over and over again as long as they were able to devalue their currency. Well, once they entered the Eurozone, they didn't have that ability because they unilaterally couldn't devalue the euro. So they have to live within Germany's monetary system now, and it's impossible for them. So they're running up massive debts. And they've been able to get away with that up till lately because the European Central Bank was willing to buy Italian bonds at extremely low interest rates. So Italy was allowed to borrow for less than the US had to borrow, for instance. But lately, since Italy has elected a government that's anti-austerity and to an extent anti-euro, now they're playing a game of chicken where the Italians are going to run up big budget deficits. The EU and the European Central Bank are saying, no, you can't do that or we won't buy any more of your bonds. And now Italy's interest rate, because they have to borrow on the open market, is double what it was just a year ago. They're up in the 3.5% range for 10-year treasury bonds, their version of treasuries. And that is a bankruptcy level event for them, because paying that kind of interest on their level of debt basically eats up their government budget and doesn't leave anything left over for all the other promises that they're making. So they're very potentially, the catalyst for the next global financial crisis. Of course, there are 10 other potential catalysts, but Italy is definitely on that list because it's not clear how they get out of this. If they give up and cut their budget and go back to austerity like the EU wants them to, then there will just be another political crisis when somebody else comes in and ramps up government spending. But if they keep spending at this level and the European Central Bank doesn't buy their bonds, then they go bankrupt. And it's not clear if there's a middle way, which I don't think there is, between those two extremes. So they have to choose one or the other extreme, apparently.
So they can either choose austerity or party on, Wayne, and bankruptcy.
Yeah, well, austerity followed by a political crisis, followed by the current situation coming back, or the current situation taken to its logical extreme, which is bankruptcy. So yeah, those are their two choices.
And let's just come back to America here. I'm just going to point. You wrote this story about this, about debt basically, and about the debt of just New York City. And then I started looking at all the other debt. I mean, are you talking about General Electric bonds, and in the same sentence, junk? GE bonds and junk. General the bond, the stock, the bond, the company of widows and orphans. That'll always be here. They were bailed out in the last crisis. Everybody thought Warren Buffett was so brilliant by loaning them money at 10%, and that dishonest, in my opinion, dishonest and incompetent old coot basically got a government bailout through all the companies that we bailed out, which was AIG, which Goldman Sachs, he loaned money to them. Goldman Sachs got bailed out, GE got bailed out, American Express got bailed out, Wells Fargo got bailed out. Everybody got bailed out in his stock portfolio. He's a brilliant investor, but this time it's not going to work out, right? I mean, that's just another canary in the coal mine. What about the overall debt picture? How do you think this? How does this work out? Do we get to the point where governments and companies say, listen, we can keep our company going, or we can pay bondholders? Oops, sorry, we're going to keep our company going. We can keep our city going and pick up the trash and keep the water running, or we can pay bondholders. Well, we're going to pick up the trash and keep the water going. I mean, where does this end, and how close are we?
Well, the stiffing of the bondholders is the second to the last part of the story. The final part comes when that causes such a crisis that the U.S. government is forced to step in and bail out all these guys. So what will eventually happen is all this debt that we're talking about, Illinois' debt, New York's debt, General Electric's debt, will be moved on to the federal government's balance sheet. They'll have to step in and bail everybody out.
Well, wait, hold on. I want to just back up. I just want to back up here, right there.
Mhm.
And I'm going to go back to your own story in New York City back in the 70s. And what did Gerald Ford, who was only president for a couple of years before Jimmy Carter, what did he do? Probably the single best thing he could have done for New York City.
Mhm.
Talk about that. What did Gerald Ford do when New York City got into deep, deep debt trouble?
He didn't bail them out. He just allowed them to go bankrupt if that's how it was going to go. And you're right, that was the best thing that the federal government could have done because, see, capitalism lives by failure. In other words, you need people out there blowing up to teach the rest of us how not to behave. And one high-profile failure prevents 20 other failures by showing people where the edge of the envelope is, where not to go further. And the government under Gerald Ford, by stiffing New York, showed everybody else that they need to behave or else they're going to end up like New York. And that ushered in a period of relatively reasonable finances on the part of states and localities, at least. Not necessarily Wall Street, but at least the people who looked at New York as an object lesson. This time around, though, Greg, the numbers are too big.
Well, wait. Donald Trump, I mean, you don't know what he's going to... I mean, what he said about... And I don't mean to argue with you now, but
No.
what he said about Puerto Rico, because I've been harping on, hey, y'all, this is your future, Puerto Rico. And he said, well, what did he say? Quote, we're going to let that go. We're going to let that go. And
Well,
go ahead.
He's also already on the case of the Federal Reserve for raising interest rates just a couple of percentage points. So when the next crisis comes, it could be that the federal government doesn't directly step in and bail all these guys out, but forces the Federal Reserve to bail them out via negative interest rates or loan guarantees or something like that. They have a lot of different tools to bail out bankrupt financial entities, and they've used them since the 1990s. You know, starting in the mid 1990s, there was a big crisis, or, you know, at the time, what was considered to be a big crisis every couple of years. And Alan Greenspan bailed out everybody. And if he didn't do it, the Treasury Department did it. So everyone learned that the government has your back, take all the risks you want, and keep the profits. But if you get into trouble, they'll take care of you. Don't worry. That was the lesson that was learned back then. And no one has really unlearned that lesson yet. So it's possible that...
Go ahead. It's possible. Go ahead.
It's possible that Trump will decide to try to teach that lesson to the system. But I think the numbers are so big now that the risk of a 1930s style depression or a Weimar Germany hyperinflation is so great that these guys are going to be terrified of anything that seems destabilizing. And the pressure on whoever's in charge of the central bank or the federal government is going to be to try to nip crises in the bud before they really get going, because you don't know what's going to happen when, for instance, New York goes bankrupt and that pulls down Chicago and that pulls down California. You know, what does that mean? Nobody knows. Nobody wants to find out. So they will try. They'll maybe learn what they think is the lesson of Lehman Brothers. You know, a lot of people think the 2008, 2009 Great Recession was because we let Lehman Brothers go bankrupt. And if we had bailed them out, that wouldn't have happened, which is really the wrong lesson to learn. You know, if we'd let all of those guys go bankrupt, we would have had a Great Recession. We would have had a couple of hard years, but we'd be in way better shape now than we are. And so it's possible that the guys who think Lehman Brothers was the big mistake will see New York as the next potential Lehman Brothers, or Chicago as the next one. And their impulse will be to bail them out immediately, make sure everybody else knows that it's okay. And the bond markets don't have to panic, and the stock markets don't have to panic because the government is there. You know, that would be a horrendous, gigantic mistake. Or that would be us choosing hyperinflation over the 1930s style Great Depression. But either way, we're choosing something that is a horrendous crisis that we've never seen in our lifetimes and is inevitable because of all the debt we've taken on in the past 30 years.
Well, you run a site called Dollar Collapse, and if and this is not a debate, I'm just thinking, this is a guy that wrote a book about a dollar collapse and has a site called Dollar Collapse, and he's talking about the numbers are too big and the bailouts, and well, we'd have to bail out. Well, something's going to give, John. I
Yes.
mean, wouldn't that be your premise? The dollar would collapse, would it not? I mean, aren't all these countries making side deals? And what Europe is buying oil in euros now, and China is trading with Russia, and India is trading in rupees, and Saudi Arabia wants to, use the real, take the yuan. I mean, isn't there a downside to all these bailouts for the dollar?
Of course. Well, see, basically what you do is you create huge amounts of pressure in the system. That pressure has to be released somehow. And it could be released through a lot of bond defaults. In other words, the deflationary path would release the pressure by everybody going bankrupt and all that debt being wiped out. But if you bail out all that debt, you shift the pressure over to the currency markets. In other words, we're creating trillions and trillions of new dollars, dumping them in the system to prop out the bond market. And then people realize, well, the currency itself is in oversupply. So as soon as I get dollars, I'm going to convert them into real stuff. I'm going to buy farmland or rental properties or gold and silver at whatever price I have to pay. And so it manifests as a hyperinflation. But what it really is a loss of faith in the currency. That's the Austrian school of economics endgame for a credit bubble, where people just give up on the currency. It collapses in value. The system spins out of control for a while, and then you reinstitute some kind of sound money. So that is the most likely way out of this for us. We have that crisis where currencies are no longer seen as viable, fiat currencies. And people figure out that giving the government an unlimited printing press is a really bad idea. And we've got to rectify that somehow.
Wouldn't they, let's go ahead, finish your thoughts. So we got to rectify that somehow.
So they go back to some form of a commodity-based currency. In other words, a currency that is linked to something real and exchangeable for that real thing. And that limits the government's ability to create or to increase the money supply. It ties it to the increase in supply for that commodity. So with gold, the reason it worked for 200 years during the classical gold standard is that the supply of gold goes up by about 2% a year, which is about equal to the increase in human population until recently. So the supply of money that was linked to gold was stable for 200 years, which means we had no inflation. We actually had a little bit of deflation most years during the 50 years leading up to World War I. And at the same time, we had strong growth around the world. That was considered at the time a golden age until World War I wiped out those thoughts. So we will go back to something like that. We'll learn the lesson of the past and go back to something like that. But we'll have to do it by devaluing the dollar relative to gold. So we'll announce on some Sunday night when all the markets are closed that henceforth the dollar is now just a name for 1/10,000th of an ounce of gold, or some number in that ballpark. And going forward, we'll be able to exchange dollars for gold via the government, and the supply of dollars will increase at 1 or 2% a year. So we'll have a sound monetary system. But that hyperinflation, that burst of inflation, will impoverish everybody who trusted the government and held on to dollars. In other words, when a car becomes $100,000 and milk is $10 a gallon and bread is $9 a loaf, your dollars aren't worth as much anymore. So if you trusted the government, you're the one who suffers as part of their past mistakes.
How do you think this would unfold? I mean, you think this is coming? I mean, the debt is so big. I mean, $100 billion just for New York City, just for their medical pension benefits, just for the medical benefits, is a stunning number.
It certainly
Donald
seems
Trump
that way
is the king of bankruptcy. I think he would let that go, just like Puerto Rico. He'd say, "Hey, listen, sorry, you elected Ocasio-Cortez, who wants Medicare for everyone, $40 trillion, whatever the price tag is outrageous. You're going to have to live within your means. We're not. The rest of the country is not bailing out New York City."
Well, the thing is, it won't just be New York City. If they go bankrupt, see, back in the 70s, they had their financial trouble in the context of most other cities and states being basically okay. So it was an isolated event, but let it happen now, and you've got all these other potential New York cities out there. So if New York City declares bankruptcy, Chicago is a next day event. Everybody's going to pull their money out of Chicago because they figure, well, if New York can do it, then clearly Chicago can do it. And then California's,
LA.
yeah, LA, if
Boston.
you look at CalPERS, oh yeah, Kentucky, New Jersey, the list goes on and on. Connecticut, all of these guys have wildly underfunded pension plans that if they were private sector entities would make them look insolvent. So once we start fearing something like that, once we see that it's possible, then there's no way to know where it ends. And that's what'll terrify these guys. That's why the federal government will be under so much pressure to bail them out. It'll be like Fannie Mae and Freddie Mac during the housing bubble bursting back in 2008, 2009. If we didn't bail them out, that would have been $5 trillion of mortgage-backed bonds that would have been at risk. And nobody knew what would happen if those bonds tanked, because they were in mutual funds and pension funds and government accounts. And
I think they should have let them tank. That's the problem. The problem is they should. If you believe in capitalism, then you believe in bankruptcy. And the problem is people believe in capitalism, but they don't. Nobody wants to take a hit.
No, we don't really have capitalism right now. We have basically capitalist socialism, where if you're an entrepreneur and you take a big risk, or at least if you're a really big entrepreneur, if you're a major corporation or a bank or the state government or city government of a big place, you can take any risk you want to and keep the profits. So we've privatized the profits and socialized the risk, because we as taxpayers have to pick up the pieces and cover the losses when these guys take risks and the risks don't work out. And that's not capitalism at all, because we're not learning anything, or we're learning the wrong lessons. And because of that, we're misallocating capital.
So if they do try to bail out all these cities, and there's going to be something's going to give. If you 100 billion here and 100 billion there and a trillion here and a trillion there, you add in the $21 trillion debt, and then Mark Skidmore, professor of economics up at Michigan State University. This is a real number, folks. They're not talking about it on the mainstream media. This is a real number. Add another $21 trillion of stuff they don't know what happened. That was the IG. They accounted for it, but they didn't really account for it. They said they spent it. Where'd it go? We had 42 some odd trillion dollars. At what point does everybody go, whoop, I'm out, no more dollars? The dollar is rising right now because it's the dirtiest shirt in the thing. But isn't there a downside for the bailouts? Isn't that, if what you're talking about is they would start bailing stuff out and then the dollar would crash and then it'd be over anyway, right? Tell me how you envision this thing going down.
Well, that's the most likely scenario.
You tell me, what would happen? They'd start seeing bailouts. They'd start seeing collapses, and they'd be so freaked out, they'd rush in and turn the fire hose on of dollars.
So they say, okay, well, here's $5 trillion to bail out states and localities across the country. And people see that and worry about what that means for the value of the dollar. So they sell dollars, not just here, but all around the world. The dollar starts to fall. Interest rates start to go up, right? Because if the dollar is tanking, who wants to lend money to the federal government that is going to be paid back in a depreciating currency? So our interest rates go up. And that causes our interest costs to go through the roof, which forces the government to borrow even more. So let's say $3 trillion to bail out states and localities, then another trillion and a half in new interest costs as the dollar falls and interest rates go up. And at some point, the whole thing blows up. There's a number out there that in retrospect, we'll look back and say, oh yeah, when total debt hit 400% of GDP, that's when we should have mortgaged the house to short everything in sight. We can't know that until afterwards, but that number will happen, and we'll look back on it and think, oh my God, that was it right there. And so the question is, when do we hit that number? What is it, and when do we hit it? And you can't know that. So you can't know the timing of all of this, but I think there's a decent chance that in the next recession, there will be so many things that need to be bailed out that we get very close to the point where people lose faith in not just the dollar either. The dollarcollapse.com is sort of a a shorthand name for the death of fiat currencies. In other words, all of these currencies, the euro and the yen and the Chinese yuan, they're all the same thing. They're all just made up with nothing backing them, and with governments there having unlimited printing presses, which they're abusing. So the concept of fiat currencies, that is what will be called into question when this happens. And the dollar might lead the process down, or some other currency might lead it down. Maybe the yen blows up with all the government that they have. And that leads people to look around and think, well, who's next? And then they realize that all the fiat currencies are in basically the same boat. So we can't know what the catalyst is, and we can't know what the timing is, which makes this a really frustrating investment thesis. But we can know what will do well when this happens, and that's gold and silver primarily, and really well-chosen farmland, really well-chosen rental properties, things like that, things that the government can't make any more of, because that's where capital will flow when the things that governments can make more of are inflated away.
You keep coming up. I keep hearing this number as somebody who interviews people. I keep hearing this number of $10,000 gold, and that's given the known things that are right now $10,000 gold. With the budget deficit, we're well over 100% of debt to GDP, with 21.6, 7. It's like if the debt clock was a fan, it'd be blowing my hair back. My tie would be doing this. So, but then you add in the 21 trillion from Mark Skidmore, and is gold? I mean, is it that outrageous to say, oh, it's twice? Oh, well, maybe it isn't 10,000 an ounce. Maybe it's 20,000 an ounce. I mean, that's the 21 trillion you can stand on. That was done by a PhD at University of Michigan. He's not a kook. He's a brilliant guy with a team of candidates, PhD level candidates and master's students that went all through the Inspector General reports for the DoD and Department of Defense and Housing and Urban Development, the DoD and HUD. And came up with this $21 trillion number. So what I'm saying, I guess I'm talking too much. Couldn't that number be an exponent of 10,000? Couldn't it be 20,000 or 30,000? I mean, couldn't we, if it was discovered, couldn't gold be way higher than what it is?
Yeah, well, the $10,000 an ounce number comes from people calculating, based on the amount of fiat currency that exists in the world, what it would take to go back to the gold standard as it used to be structured. In other words, if you have that much gold backing of the existing fiat currency in the world, what price of gold makes that balance? Makes the equation balance. And $10,000 an ounce pretty much does it right now. However, we're continuing to increase the amount of fiat currency in the world. We're continuing to take on more debt. So the number is rising along with the amount of paper currency in the world. And if you assume that the fiat currencies that are out there today are not just going to fall and then be revalued, devalued, but they're going to fall to zero. If they're just going to evaporate, then your number for gold is infinity. So somewhere between $10,000 an ounce and infinity is probably where gold will end up in the next monetary system after we have the reset. Again, can't know the timing, can't know the exact progression, and we can't know that final number for gold and by implication silver being a lot higher too. But you can say with some certainty that those are pretty good things to own because their trajectory is going to be upward. Even if gold stopped at $5,000 an ounce, you still make a great return based on today's prices. But if it goes, to $20,000 or $30,000, and I'm not predicting that, but it's certainly mathematically possible, depending on how emotional the markets get when all of this really gets going. Then that's a lifetime of investing right there. That's all you really had to do was buy a bunch of gold and silver right now and then ride it until this thing plays out. And you've basically done your financial thing for a lifetime.
But you feel like we're closer. Of course, you started your site in 2005, and it was imminent back in 2005. And here we have 13 years later. Is that right? 13 years later, and boy, they've just exploded the debt everywhere.
Yeah. So it's still imminent. It's still going to happen soon. You can't trust me about things like that because, as we talked about, I thought it was over in 2006. But in the meantime, the fact that the numbers have gotten so much bigger and the imbalances have become so much more outrageous means that when this does blow up, it's going to be that much bigger of a deal. It's going to be more of a crisis than it would have been if the whole thing would have just stopped cold in 2009. So in one sense, people who acted on the idea that the system was going to break down back in the mid-2000s were way too early. But in another sense, they positioned themselves for even bigger gains if they did it right when this thing blows up, because it'll be that much bigger. There's that much more debt that has to be wiped out. There's that much more fiat currency that has to be devalued, and there are that many more ancillary crises. In other words, things that are knock-ons to a financial crisis that are possible out there. Politics and geopolitics and war tend to follow big financial crises. So the world will get crazy on every level if this plays out this way. And I hate the idea that we're creating conditions where that's possible. But the math seems pretty straightforward. It seems like we have to have a gigantic financial crisis to get out from under this stuff, or at least a massive and sudden monetary reset, and that's going to destabilize a lot of political systems along the way. So, Greg, you and I are going to have amazing, crazy things to talk about for at least the coming decade.
I wanted to talk to you one last thing about the war card. I mean, could the war card get flipped over? And they're mixing it up in the Middle East now, Gaza, the Israelis, China, South China Sea. There's all kinds of flashpoints, a couple of big ones I named right there, but there are some big flashpoints that could happen. The war card, is that all part of this?
Well, there's never been a time in the past 100 years when we weren't on the edge of some kind of big war. We've always been close to a conflict with somebody scary that would have potentially destabilized everything. And we had a lot of those. We've been more or less at war since 1914. Sometimes it was the Cold War, but frequently it was shooting wars. So it's no surprise that we're there now, because we've been there for such a long time. But a lot of the stuff that we're doing right now, I think, is making the danger more extreme than it has been for a while. The South China Sea, for instance, China, because it's an emerging power, they want to flex their muscles, at least in their own neighborhood. They're claiming parts of the South China Sea that the international community thinks ought to be open water, free to everyone. So the U.S. is sending ships in there to patrol that area to make sure that everybody knows that we're keeping that part of the ocean free for everyone else. And China doesn't like that. So our battleships and our aircraft carriers and destroyers are bumping up against each other there. And that creates the possibility of an accident, where somebody panics and shoots somebody else, and then it just spins out of control. And meanwhile, in Syria, for the past couple of years, Russia and the U.S. have been bombing each other's
proxies.
Yeah, proxies plus advisors. Russia has advisors with their proxies, and we're bombing those guys, and vice versa. So that's got the potential for something very serious that we really, really don't want to happen. And yet we're kind of playing chicken there right now and hoping that it doesn't blow up. And then Israel in the Gaza Strip now is fighting again. And it's not clear how the great powers line up in the next Arab-Israeli war. We could be on opposite sides like we were in the past, which is even more dangerous now. And meanwhile, we're developing all these weapons that are just insanely scary. We have hypersonic missiles that can't be tracked very well and can't be defended against because they get where they're going in like 15 minutes. We've got autonomous drone submarines that can be equipped with nuclear weapons and apparently are going to be equipped with nuclear weapons. We've got RoboCop or Terminator kinds of robots that we're building for battlefield engagements out there. And of course, biowarfare and chemical warfare is progressing nicely. So we've got a lot of things that we've never used in the past, and that almost don't even belong on a planet. They're so serious and so scary that once they're used, there's no way to predict what happens. So that's one more thing. That's another thing that is completely terrifying from the point of view of an over-indebted, over-leveraged system. See, when you borrow too much money, you get very fragile. And any old thing can destabilize you. And a war that involves weapons that have never been used before, and that once people see what they are, is absolutely terrifying, could easily be that catalyst, that sends us into a financial crisis. Or vice versa. The financial crisis could cause the war, or the war could cause there's no way to know, Greg. There are just so many things right now that are the result of past mistakes that are coming back to bite us. That I can't imagine being exposed to the financial markets right now to any great extent. You want to be as safe as possible.
Hard assets.
Hard assets that either you own or stored in a very safe place that can't just evaporate in a financial crisis or can't be confiscated when the government starts to go crazy and is desperate for funds and is just taking it from anybody. And history has a lot of examples of things like that, where major countries basically just resorted to wealth confiscation or price controls.
Especially in war.
During wars, we do things like that. So I don't know. It's weird to say that there's an optimistic angle in all this, but the optimistic angle is that this is an investment thesis. If the world is going to get crazier than usual, then your investment thesis that could probably work out really well is to go conservative. When they go crazy, we get safe. And gold and silver are the things that have historically worked. You can go all the way back to the Roman Empire when they had their hyperinflation and their price controls with the death penalty attached to raising prices. Gold and silver got more valuable rather than less valuable. And it's been true every single time there's been a financial crisis since that time. So there's no reason to think that won't happen eventually. And again, eventually is a squishy word. It's hard to know whether it's this year or next year, but I think it could easily be in the not too distant future.
And one last thing I wanted to tell you, I was going to tell you this off camera, but I just hit me. I want to tell it to you now. When I first started in 2009, I went on August 24th, 2009, and I would write all these pieces and I'd put them up on usawatchdog.com, and I'd get 5 reads. I'd get 10, 15, 20. I'm like, I spent 6 hours on this with links and analysis, and I spent all this time on this. And then I remember I was sending some of these pieces to you and a couple other people, but to you, to dollarcollapse.com. And the first time that you put one of my pieces up, I got 10,000 views. I went from getting 5 and 10 to 10,000 views. Yeah. And it was because of you, my friend. And so I have a special spot in my heart for dollarcollapse.com. Still one of my favorite sites today, and you do such a good job. Like this article you put together with your not only is it an aggregate site, and you pick really interesting things to put on there, but you also write very interesting things like this $100 billion debt for New York City just for the retiree medical benefits alone, which I thought was a brilliant piece of work, and you're a brilliant guy. So I just wanted to share that with everybody. Dollarcollapse.com is the website, folks. You should go on there. John Rubino, the founder and the proprietor of dollarcollapse.com. John Rubino, thanks for joining us today on usawatchdog.com.
Thanks, Greg. Great talking to you.